Welcome to Chapter 23 on mutual funds. So first of all, what is a mutual fund? Well, a mutual fund company is an investment company that sells shares in its various funds and uses those monies to buy a variety of investment assets. Now, you're probably thinking, why do I need to know about this? Well, at some point in your life, hopefully, you will own mutual funds. Why is that? Well, as you can see from this paragraph, over 45% of American households own them, and of those who've been educated, it's close to 100%. The reason why is that most 401ks and 403bs and any other non-taxable accounts limit what you can invest in to just mutual funds. So for instance, I have a pension with, not a pension, but a 403b, which is for non-private entities for their employees to have some kind of non-taxable account. And it's like a 401k. A 401k is if it was a private company. So 403b means if you're employed by the government or some kind of NGO, non-governmental organization, but not a private company, then you would have a 403b. And in those 401ks or 403bs, most of them limit you to just those mutual funds. So you need to know about mutual funds and what they are. And the average amount that households own is $125,000 worth. Mutual funds are popular, but there are risks in holding them, just like there are risks in holding any asset. So, to help ensure that Americans fully understand the risks involved with mutual fund investment, the industry faces a myriad of regulation. At the national level, investment companies and the mutual funds they offer are regulated by the SEC, the Securities and Exchange Commission. And the SEC is responsible for regulating the structure and operations of those mutual funds, including how they advertise and how they inform investors. So for instance, if I invest in a mutual fund, I have to have been given the prospectus for that mutual fund. I mean, that's in contrast to if I invest in or buy a single stock, I don't have to look at any company details. I could just buy the stock. That's not the case with a mutual fund. You're going to be asked if you want to see the electronic version of the prospectus, or it's going to be sent to you by mail. I don't know how many forests I've destroyed by getting the prospectuses for these mutual funds by mail, but it's probably a few, to be honest. Huge amount of paperwork. So usually I get my prospectuses now electronically. So, as I said, my last point here, you do have to have that prospectus. So there's several different types of mutual fund. The first type is an open-end mutual fund. So this is a fund operated by an investment company that does not limit the amount of shares the fund will issue. Oftentimes what mutual funds do, I think all the ones that I own are open-end mutual funds, is if they have more money coming in, then effectively what they do is when you're buying the shares in the mutual fund, more money coming in than going out, I should say, is what they effectively do is issue more shares. Otherwise, if you think about it, the net asset value would change, and it would change such that the price of the mutual fund would be bid up, ceteris paribus. So it means because there's an increased demand, but the supplies change the same, the price would go up, and so it would become disconnected with the underlying assets that it holds. So of course, what does a mutual fund do? It takes your money and it effectively turns around and buys shares. But if the actual shares it holds don't go up, but for some reason there's more demand for the mutual fund, then that obviously increases the mutual fund price without having what's backing that mutual fund going up in price or value. So as I said, the mutual fund usually just issues more shares. And the investment company can sell shares to investors at any time. The investment company can also buy back shares. So for instance, if there was a net outflow from a certain investment company's mutual funds, then obviously that would usually cause the shares to decline. But if that meant the net asset value was then greater than the actual price of the mutual fund, in other words, what's being bought and sold is less than what the value of the shares is, then the investment company will buy back shares or allow investors to redeem their shares at any time. They will buy back shares in that latter instance. And mutual funds usually hold about 4 to 6% of their total assets in very liquid assets, such as bank CDs, or cash, or T-bills, depending on the type of mutual fund. Now, most mutual funds are equity funds, but mutual funds don't have to be just equity funds. They can be different types of funds, different types of assets in the fund. So equity funds means that basically the mutual fund takes your money and then turns around and basically buys shares. Now, there are different types of, as I said, mutual funds. So there's bond funds. So here the mutual fund just takes your money and turns around and buys bonds. And there can be government bond mutual funds and corporate bond mutual funds. There are also hybrid funds. Hybrid funds usually mix just equities and bonds. Sometimes you can get funds that actually are commodity funds as well, where they might buy the commodity itself as well as stocks that are engaged in mining or exploring for that commodity. Fourth on the list is a money market fund. A money market fund invests in the money market. You know from previous chapters that the money market consists of commercial paper, treasury bills, in other words, very short-term bonds, and that essentially forms what the money market is. Oh, and CDs as well are traded through the money market. Lastly, there are specialty mutual funds, and I hold a couple of specialty mutual funds. In fact, I'm going to show you my portfolio later on, not because I want you to copy what I do, but just to show you an example. So the equity funds are best suited for investors who have a long-term investment strategy. Long-term investment strategy means staying in the market for usually longer than 10 years. And they account for over 40% of all the assets in the mutual fund industry. And there's a wide variety of these equity mutual funds. There's so-called growth funds. Those are stocks, these are mutual funds that invest in stocks that have above average growth potential with high PE ratios, price to earnings ratios. It means they're quite high valued because of their future potential growth. And then aggressive growth funds, these are where you get really strong growth expected in the future. There's also, contrasting that, there's also income funds. These invest in mutual funds that pay, in shares. So these mutual funds invest in shares that pay essentially dividends. And you're not too worried about the stock price going up. You're more worried about having a good dividend that's pretty much guaranteed going into the future. You can have a mix. So going back to the first bullet point, have a mix of those two things. So you can have growth and income funds. So these are funds that focus on both those things. They invest in what they consider are the best stocks for growth and the best stocks for income. You're probably thinking, what kind of stocks are we talking about here? Well, a good growth stock might be Tesla. Why? Because Tesla is, rapidly expanding company, given the fact it's in the electric vehicle market, the EV market. You're probably thinking, well, what's a good income stock? Well, AT&T is a perfect income stock because AT&T isn't really growing all that fast. However, it pays a really nice dividend of over 6%. So, basically the growth and income funds mix those two things together. Next, so the third bullet point on this list is the international or global equity funds. So with a global fund, the fund manager invests in equities around the world, whereas international funds tend to invest in equities outside of the US. So global funds, are basically usually weighted towards the US, but they obviously have other major stock markets in the world. They're usually weighted by the size of the stock market. So for instance, they contain a lot of stocks from Europe, Japan, very few from South America, very few from Africa, and up until recently, very few from East Asia, although that has looks as though it's growing, the East Asia portion, partially because of China now allowing foreigners to own their stocks of their companies. International equity funds are basically usually concentrated in a specific geographical area, or they can be international in general, once again weighted by the markets but ignoring the US. So usually the highest weight in those international funds, if it's for all the world except the US, the greatest weight's probably going to be in Europe. But I invest with a provider that has things like European equity mutual fund, and I invest in another one, or I have done in the past, which is Eastern Europe, Middle East, and Africa mutual fund. I also invest currently in an India equity fund. Lastly, and these tend to be the cheapest, what I mean by the cheapest is that their expenses are the lowest, are index funds. So these basically mimic the weightings given to the indexes that we follow on a regular basis. And there are essentially four indexes that are followed pretty much on a regular basis. They are the Dow Jones Industrial Index, DJIA, which consists of 30 large industrial US companies, and then the S&P 500, which is the biggest 500 companies in the US, so that's a much broader index. Then there's the NASDAQ, which tends to consist of tech companies and biotech companies, or the Wilshire 5000. Now that, or I thought it was a Russell, there's a Russell 2000 as well. The Russell 2000 tends to be most weighted towards smaller companies, and then this Wilshire 5000, I guess, covers a whole huge number of stocks in the US, so of all different stripes. Now those index funds just basically follow the index. So they're not what we call actively managed. In other words, no one at the investment company is saying, we need to invest more in this company and less in that company. If it's in the index for an index fund, then you're basically going to be buying that stock with the same weight that it has in the index itself. So these are what we call passive funds. They aren't managed, and so the expense ratio, it's called, the expense ratio is usually the lowest for those types of funds. Some of them can be incredibly low. The bond funds are also interesting in and of their own right. Why? Because we talked about equity funds, but with the bond funds, they invest in a variety of different bonds, and these can be government bonds, or they could be private sector bonds, corporate bonds in other words, or they could be short-term bonds, or they could be a long-term bond mutual fund, or they could be foreign bond mutual fund as well, or they could be developing country bond funds. I've seen one of those too. So what's the advantage about investing in bonds? Well, bonds don't usually pay very much in terms of the yield compared to what you can get in the stock market, but they are more stable than stocks. So bond mutual funds tend to be bought by investors who want to protect the market value of their savings, and those who are interested in those coupon payments coming from bonds. So basically in income. Bonds don't pay a dividend. I don't know why he's put that there. It should be the coupon. So bond mutual funds apply to risk-averse savers as well as those near or close to retirement age. So for someone who's about to retire, you don't want them having a whole load of their retirement fund in equities, because the stock market occasionally crashes, and you never know what kind of thing could happen in the world overnight even. So having large amounts of money, if you're about to retire and you have like 98% of your retirement funds in equities, that's probably not a good idea, because of what could happen. Better to be in bonds, because bonds don't tend to crash and move around in terms of their prices in the same way that stocks do. So here you can see they include things like corporate or investment grade bond funds. So these funds often are made up of bonds and other debt instruments issued by well-established corporations. And there's a variety of different types of funds here, so we'll look at these. Treasury bond funds, I've already talked about those. So they're just basically debt instruments issued by the US Treasury. High yield or junk bond funds, so these invest specifically in high yield bonds. So these high yield bonds, why would a bond pay a greater yield? Well, it pays a greater yield, of course, because the price is lower. Price being lower means it's usually more risky. So that's the characteristic of that particular type of fund. International and global bond funds, so exactly the same thing as their equity fund counterparts. The global ones tend to buy bonds from all over the world. The international ones tend to focus on certain parts of the world. Then there's mortgage bond funds. So these are bonds issued by local governments or local authorities, and they're called munis, of course, municipal bonds. So there's muni bond mutual funds, and then there's multi-sector bond funds. Just like there's multi-sector for equities, there's multi-sector as well for bonds. So these funds purchase a wide variety of different types of bonds and debt instruments. Those are usually obviously actively managed. Now, with bond funds, you don't really have passive bond funds because there's no index that's agreed kind of upon for bonds. So it's not like the stock market in that way. So there's no index fund here. Let's talk a bit more about these hybrid funds. There's a variety of different hybrid funds now available. As I've said, they often consist of, well, they not just often, they mostly consist of mutual funds that have a mixture of both bonds and equities in them. Now, there's some very interesting kind of variations on this for hybrid funds. One is a so-called target date fund. Now, this is a fund that has a maturity date, and that maturity date is when the bond fund, or the hybrid fund, I should say, kind of expires, and they pay your money back, whatever you've got invested in them. Now, these target date funds are interesting because what they do is they change the weighting between equities and bonds as you get older. So as you near your retirement date, so if you set a date of, say, 2030, well, it's 2021 now, it says 9 years to go, then you're going to find that the hybrid fund is still probably at least 50% in equities. But as you get closer and closer and closer to that target date, so 2030, the weighting is going to shift more and more in favor of bond funds and less in favor of equity funds. Target market allocation funds. Managers of these funds continuously change the asset mix of the portfolio to ensure a constant allocation between stocks and bonds, foreign and domestic instruments, and so on. There's other funds as well, by the way. I was looking at one lately where it's an actively managed target market allocation fund. It's a market allocation fund, it's not really target. This fund that I was looking at actually changes the mix between equity funds and bond funds according to the position of the business cycle. So obviously, if you're in an expansionary phase of the business cycle, you want to be in stocks. If you're in a recessionary phase of the business cycle, you obviously want to be in bonds. So the fund managers have to shift the funds that they're looking after around between bonds and stocks. Real return funds. The goal of these funds is to ensure a real rate of return that's stable. They tend to invest in a type of bond called a TIPS bond. And these are inflation protected bonds. So that's why there's the IP in there and the TIPS. World allocation funds. In these funds, the fund manager changes the asset mix of the portfolio to ensure a constant asset value ratio between different regions of the world. So that's another type of hybrid fund out there. So as an example, let's look at my asset breakdown for my retirement fund, and this is for my 403b. So it's my main pension source. First of all, look on the right hand side. You can see the source is of employee funds, in other words, where I've put money in, and then the employer matching is where I put money in and Texas A&M Corpus Christi has matched what I put in. Now, these types of 401ks or 403bs are really good because what happens is it's effectively free money. So when I put money into there's a limit to how much you're going to put in every month, but when I put my maxed out amount into my 403b every month, it's matched by Texas A&M Corpus Christi. So that means if I put 1,000 in, they put 1,000 in. So it's really free money, and it allows you to build a pension much more quickly. Now, these types of employer matching pension type setups, schemes, they tend to be offered by large corporations or governmental bodies. I'm afraid you don't tend to get these in smaller companies. So if you're working for a small company, you probably won't have such a good pension scheme. So let's go to the far left. You can see I've shown you, what type of assets my mutual funds actually invest in. And you can see that I'm holding about 45% in foreign stocks, around 35% in domestic stocks, around 12% in bonds, and around 5% other, and about 2.5% short term. So you can see I'm still heavily weighted in stocks. If you add up stocks, you're looking at 79, nearly 80% of my portfolio is still stocks. Now, if I think the stock market is gonna crash, then I will, and I can do this with a day's notice, I can pull money out of my my equity mutual funds, and allocate them into either cash or into a bond fund or something like that. Let's look at specifically what types of mutual funds I'm actually holding. So that's the middle one. I'm holding a target fund. You can see a target date fund, and it's Fidelity Freedom 2030. K means it's an institutional investment fund. In other words, I get a better expense ratio by doing it through an institutional setup. In other words, through my company in this case. In other words, I could go and buy this Fidelity Freedom mutual fund by myself if I want, but I would pay higher expenses if I did. The second biggest mutual fund for me is a Fidelity Floating Rate High Income Fund. What that is this one's interesting, is it's known as a banking fund. It's a specialty mutual fund. Basically what it does is it loans money out to companies through Fidelity. So Fidelity, who basically I've got my pension with, they actually turn around and they loan money out to companies that way. So that's what we call a banking mutual fund. It wasn't covered in the list, but it's a specialty mutual fund. Next, Fidelity Nordic. So that's an equity mutual fund, and it's specifically is investing in the Nordic countries. The Nordic countries, of course, being Norway, Sweden, Denmark, Finland, and Iceland. Those are the Nordic countries. Next, there's convertible securities. Convertible securities are interesting because they are once again a variation on kind of a hybrid fund. With a convertible security, what happens is they start off as bonds, and then there is an agreement to convert those bonds into equity at a certain point. So it's a specific type of asset class. Next biggest fund I'm holding is Fidelity Europe. I do hold some US mutual funds, but they're not my biggest weight. You can see that. So hopefully that gives you an idea of, why these mutual funds are important, why you need to do some homework on what you want to invest in, particularly if you end up managing your own pension going forward. Now, for most of you, that's not going to be a concern for a few years, but at some point it will be. And the one thing I want to tell you is that no one teaches you or tells you anything about this in a company. You've got to find this out by yourself. You've got to really educate yourself about it, and that's what I've found. I've made some painful mistakes, I admit, but I think I've kind of sorted out what I like as mutual funds and which ones I'd like to invest in, and I haven't done badly, I don't think. I usually manage to match the market, but I don't have any blowout years or anything, but that's not my aim to have any blowout years. In other words, this is your pension. You don't want to be, you can't be invested in single stocks anyway. So it's a question of where you put your money into which mutual funds, and therefore you've got to have some kind of knowledge about, one, the expense ratio, and two, where that mutual fund itself is invested. Next, we move on to these money market mutual funds. I don't tend to like these money market mutual funds, but some people do. They have a very low default risk. Of course, they're in short-term commercial paper and T-bills. A useful investment vehicle for short-term savings. And it's interesting, you can have money market accounts. Now, those money market accounts are with banks usually. We've covered those earlier on in the course. They invest in the money market, but it's like a checking account almost. Now, those are FDIC insured versus money market mutual funds. Now, that is a mutual fund, and you now know what a mutual fund is. Those are not FDIC insured. Why is that important? Well, it's important because if you really want to invest in the money market, then it's probably better to do it through a bank. With money market mutual funds, if for some reason the fund goes belly up, essentially you lose money. You could either lose the whole lot, that's unlikely, but you lose a portion of what you put in. So these commercial banks, thrifts and credit unions, they offer money market accounts. They're not mutual funds, but they are accounts, money market accounts. Now, with mutual funds, as I've said already, expenses are really important. So how are these expenses calculated, and when do you have to pay them? Well, first, when do you have to pay them is important. And there are different types of funds, who charge different fees, expense fees, in different ways. So a front-end loaded fund is a fund that has a fee charged to the investor when they purchase the mutual fund shares. Then there's a back-end loaded fund, which sometimes they call contingent deferred sales charges, or redemption fees, or reload fees. They're sales charges imposed when the investor redeems their shares. In other words, they sell. Most mutual funds have a clause which specifically states if you sell before a certain amount of time, with fidelity it's usually 3 months, you're going to get a back-end load charge. You're going to get a fee for selling before the 3 months. All of these funds, whether they have a front-end load fee or a back-end load fee, but they all charge those load fees. Usually if you invest in the funds of the company that you're putting the money with, so with me it's Fidelity, if I invest in the Fidelity managed fund, then I don't pay any of those front-end or back-end load fees. Now, with mutual fund annual management fee, everyone pays those, and they can be extremely small, which they are for the ones that track indices, so they're index funds, or they can be quite substantial if they are quite successful and managed. Obviously, the fees are used to pay the staff who make those decisions. There's also a so-called closed-end fund. The closed-end fund is a fund that issues shares once, so it doesn't adjust the shares and the shares issued, and it's done through an initial public offering, just like shares. And these closed-end funds often sell at a price above the net asset value. so at a premium. And sometimes they sell below as well. More likely to sell above net asset value if they're successful. Why? Because investors come in and buy the closed-end fund. That pushes the price up, and you can push the price up beyond the net asset value. Of course, it could go the other way. If the fund is spectacularly unsuccessful, then you could find that its net asset value is actually higher than its actual selling price. Lastly, we're going to move on to look at ETFs, or exchange traded funds. This is a recent innovation, really. The first ETF, as you can skip to the bottom of this PowerPoint, 1993 it was launched, and it was the first ETF was designed to track the S&P 500 index. And what are ETFs? Well, exchange traded funds. It's an investment company that issues shares that are traded daily on stock exchanges at a market determined price. Now that differs from mutual funds. Why? Because mutual funds consist of shares that are being bought, but the price of the mutual fund is not determined until the end of the day. Whereas ETFs are traded like a stock is traded. So ETF shares, you could just buy them through a broker. Anyone can buy them. And most people buy them as part of their own brokerage accounts. But there are some pensions now that permit ETFs. I was surprised to see that the Texas A&M plan, now if you go with one particular provider, you can buy ETFs. ETFs in the US are very similarly structured towards open-ended mutual funds. Next, hedge funds. This is a type of mutual fund in that they pool the money and savers together. But in this case, it's not really open to the general public. It's not for small investors. So you have to be a big investor and you have to have a high net worth to invest in the hedge fund. And these are categorized as alternative assets so that they don't fall under certain regulations that govern things like mutual funds. And usually the minimum investment is between $1 million and $20 million. These hedge funds are not buying shares of a fund, and they're usually investing funds through a partnership. The SEC regulations stipulate hedge funds can have no more than 99 investors if the minimum annual income of less than $200,000 over the past 2 years, or they must have a net worth of at least $1 million alone or with a spouse. So in other words, if you're going to launch a hedge fund, probably better to just go with high net worth individuals who have a net worth of at least $1 million alone. Next, real estate investment trusts. These are similar to closed-ended funds that invest in real estate or mortgages. So we have mortgage investment trusts as well, or mortgage REITs. These are often abbreviated to REITs, R-E-I-T, REITs. They're exempt from federal income tax as long as they derive 75% of income from operations related to real estate, and they pass through at least 90% of their net income to shareholders. And those REITs tend to be highly liquid assets and traded on stock exchanges. So here we're finishing the chapter by asking some questions. I'll answer them for you. Equity funds seem to be the most popular mutual fund. Would you recommend this type of fund for a person who is close to retirement age? And he said 62 is retirement age. I didn't realize that. I thought 65 was retirement age, but anyway. he said, I think you can retire from 62 years old if you meet certain conditions. Why and why not? Well, the answer, obviously, if you're close to retirement age, you don't want to be so heavily weighted towards equity funds. So that's why you don't want to be so heavily weighted towards equity funds. What's the specific reasons? Because equities tend to be a lot more volatile than bonds. And so owning more bonds means that you have more protection of your capital, of what you put away already. So the investment company turns the funds over to a mutual fund manager who in turn buys a portfolio of securities. Are mutual funds insured by the FDIC? The answer is no, they're not. When you give someone total control of your investing strategy, what could happen? Well, most companies that run these pensions, 401ks and 403bs, have an advisory arm. So for instance, with Fidelity, who I'm with, I could get advice and could get them to tell me what mutual funds to invest in. If I give total control of my investing strategy, what could happen? Well, they're supposed to act in my best interest. The fiduciary responsibility, as it's called. However, they may invest in funds that they want to see be successful. And these funds may not be good funds in the sense of me protecting my investments, protecting my pension, or increasing my pension to a level where I can comfortably retire. So that can be the problem. What are ETFs? He's got the letters round the wrong way there. It's EFTs, but he's put ETFs, it should be. They're exchange-traded funds. In other words, they are funds that basically buy stocks or bonds, but are quoted on a second-by-second basis on the stock exchange, and so they can be bought and sold very quickly, unlike mutual funds, which can't. What is causing these funds to gain popularity? The reason why they're gaining more popularity is they're much cheaper in terms of the expense fees than mutual funds. That tends to be the advantage. Thank you very much for listening, and I hope that was useful.